Good afternoon. This is Trader Tim from over at eminimind.com doing a Thursday trade recap for the week here. It's Thursday, the 27th of August, 2020. Before we get into the ES trades for the week, wanted to just talk about something that we've been talking about a lot in the Tuesday trading room, and that is the importance of being able to hedge when we get into this type of situation where the market has just been on a tear. You might more than likely have some kind of 401k or long-term account that you don't really want to just sell out of the positions that you have and then try to buy back in. The benefits of the dollar cost averaging and letting dividends reinvest and just growing that account for a more conservative, purpose longer term. But we also don't want to just let the market pull back and not be able, just kind of watch those gains kind of slip away, at least temporarily. So what you can do in this situation is use a hedge, something like buying puts, because the benefit of the option is that it's tied and has an impact to the price has an impact from the volatility. So when you are at a high like this, or when the market is up and volatility is low, you can buy out of the money puts, like a 320, 330, even a 340 for dirt cheap. And so, it ends up being maybe around half a percent, quarter to half a percent of my account is kind of the amount of short hedge that I'll put on and or allocate. But then what that gives you is an asymmetrical risk, reward to risk. So they cost basically nothing. And then if the market goes down, it doesn't necessarily even have to go down all the way to your strike. But if the market pulls back and goes down, you will typically see a rise in volatility. So that inflates the option price. And even if you make a couple percent on your hedge, that you're capitalizing on the pullback, which you wouldn't be able to do if you were only long. So I just wanted to highlight that strategy, something I've done for a long time. And you don't really have to pick the exact top like at the beginning of the year. Okay, it's a new year, we've been rallying pretty good. Let's put on even if you just get a couple of put contracts, of option contracts, you get a really big benefit and asymmetrical reward when the market does pull back. So they're not all gonna, result in, a huge ripping sell-off, but when they do, it certainly is nice. So that kind of stems from the Nassim Taleb Black Swan kind of theory of investing and hedging, which is obviously pretty popular here, as most of you are kind of managing your own portfolios and not just trading. So if you think of yourself as a money manager, a portfolio manager, or even your own little hedge fund, it's okay to kind of take control of all your investments if that's something you want to do, and treat it as though you're a money manager. So let's move over to the ES. Now today, well, really this whole last couple of weeks, the counter trend, like shorting, has not been very advantageous. We have not had high ticks that line up with high price. Pretty much every single day we have rallied into the close. We weren't able to quite make a new high at the close today, but every time we have some of this intraday selling that we put new lows in on the day, it's being bought. So really coming into this week, was kind of not really interested in counter trend shorts, just interested in buying pullbacks until something changes. And we had the first retracement of the morning on the 5-minute, like the bigger retracement that's set up, didn't have anything there. There was no bounce off of that level, so there was really nothing to buy on the 512 tick chart. But then we came down and kind of made this double bottom here, and that's where we broke the swing high, and then we pulled back to the 50%, and that set up pretty much the first or the second big run up for the morning. Now, when you get these quick rallies off of your entry and price goes through the negative 23, in this case even beyond the negative 61.8, you can draw a high-to-high extension to trail your stop. And if you have a couple of contracts, then you're able to stay in the trade longer and just trail your stop on the next retracement, and it goes up to its target. You can draw up to the next swing high there and just keep doing that until you get taken out below the 61.8. So that's a pretty good way to trail your stop, not have to necessarily make 10 trades on one push higher. You can just trail your stop for most of the move in many cases. Yesterday was similar as far as one long trade, and that occurred actually about the same time, quarter after, about 40 minutes or so after the bell. But it was a little bit different yesterday because we started off a little more sideways, and we had a retracement set up here that was kind of visible on the 5-minute, but we were still pretty sideways at that point, and we didn't really have much in terms of retracements before that. First candle was pretty bearish. Third candle was a little bit bearish, but then to see it all, most of it taken back and almost making it our way up to highs was a pretty strong sign. So once the next retrace, we hit the negative 23 target, and the next retracement was the one that I just took right at the 50%. So even though yes, it's visible on the 5-minute, it's the second one in the trend. The distance between the 50 and the 61 was plenty small, and we had broken highs. And my thought was, okay, we're likely, we may not get another pullback opportunity if we break and start ripping. And that's kind of what ended up happening yesterday. And so again, if you want to, if you have a couple of contracts and you can just trail your stop below the 61.8, start doing that once you come up and hit the first target like that. Just put your stop 2 ticks below, and then if you do rip really strongly and you don't want to have your stop way down here, you can draw from highs to highs and get that stop up a little bit higher. You can also just put your stop below the swing low. So you get the first push up, it pulls back, it makes a new high, and you bring your stop up underneath that swing low, next one, all the way up until you get taken out. But the key is to wait for that break of new highs. So let's say our stop is here, and we make a new high, so my stop is still here. We pull back, stop stays the same, and then we make another new high. We break this high. Now I can move my stop up to the next swing low. And again, just a tick or two below that swing low. So in a situation like this where you pull back, you make a little bounce, I wouldn't bring my stop up yet because we didn't make a new high. So my stop is here, and then we'll just pretend like it's happening in real time. Market makes a little bit of a bounce, my stop is still here, and then the market pulls back a little bit further and then makes its new high, and then I can bring my stop up underneath the next swing low. So just by continuing to do that, you end up with your stop all the way up here around the 51 and change, and capturing a bigger portion of the move. So that way you're not stuck having to get in and get out 5-6 times or 5-6 trades along this one push up. If you have put on a if you can try to get 3 contracts going, then you can have one to have a first target of 3 points, then you can trail the second 2 and catch some really nice runners. As far as Tuesday's trade, I posted the video from the live trading session. Both of those were longs, both of those were winners. So pretty good week. Last week I really didn't have much of anything as far as ES trades, and then the first 2 weeks of the month were kind of blah. So nice to see a little bit of a change up in a little bit cleaner, easier trading on the ES, which coming into the week I didn't really have super high hopes because when you get into these situations where you're gapping up at highs, sometimes there's not that many opportunities to get into the trend. But things have been pulling back at least enough to get, in the case of today and yesterday, to get at least one good trade off. So that's what's been going on as far as this week in the ES, and then keep in mind the opportunities to maybe put on a hedge for the longer term accounts in case we do get some kind of a pullback. Always nice to be able to capitalize in both directions, which is obviously why being a trader is so great. So I won't be around this weekend, so if you do send me an email, I'll try to get back to you next week. Feel free to put your comments below. I hope everyone has a great rest of your week, and we'll talk to you soon.